The last decade has been terrible for this North American giant. A nightmare for a colossus that had become the lord and master of all the skies of the world. Even in recent months, Trump's wars have brought him headlines like this one.
Trade tension grows. Chinese airlines reject Boeing airplanes and force them back to the US.
This was the latest blow to a company that has been taking a real beating in recent years, but obviously that is not the worst thing. After all, there aren't many planes to spare. Finding alternatives isn't easy. And besides, well, things are getting back to normal, more or less. No, the big problem, is not the interruption of Boeing's sales to China. The problem is that the Asian giant is now going to do everything possible to disconnect itself from North American products that may be more sensitive. And that's where airplanes take the lead. In fact, during this entire first quarter of 2025, although Boeing managed to deliver 18 aircraft to Chinese companies, it did not gain any new orders. And most likely, the Chinese will now look to Airbus, and above all, to their own national alternative, to COMAC, the dream of a nation, as Xi Jinping calls it. COMAC is a Chinese company that has developed the C919, a narrow-bodied aircraft that is a direct response to the Boeing 737 MAX and the Airbus A320neo. Of course, for now, there are only 16 such aircraft in flight. But clearly, the point is that this latest Trump war has most likely been the definitive turning point for the Chinese to do everything possible to multiply their domestic production. And logically, the problem is that this could seriously affect future demand for Boeing aircraft. Because one thing is clear, China is the world's leading aviation market today. Just to give you an idea of what we're talking about, it's expected that over the next 20 years, the Chinese will expand their aircraft fleet from around 4,400 at present to more than 9,700 aircraft. 10,000 aircraft is a lot of planes. In other words, it's the latest blow for a company that, although it was once the great benchmark in the skies around the world, these days it's far from the market leader. Because in terms of competition, Europe's Airbus is giving it a real beating. And as I said before, the last decade has been all turbulence for this historic American company. Pay attention to everything we're going to tell you today, because we're going to try to see where exactly Boeing is and what to expect from it. Listen up. Ever felt overwhelmed by the sea of AI tools out there? Some are great for writing, others for images, some for coding, but juggling them all is time-consuming and expensive. That's why we're excited about Chat LLM Teams, an all-in-one powerhouse where the best AI models live under one roof. Think ChatGPT 4.1, Claude 4, Gemini 2.5, Grok, DeepSeek, and more. No switching platforms. And with Root LLM, the system automatically picks the best model for your prompt. Just $10 a month. You will have access to all this. Link in the description. Need visuals? You can generate pro-level images and videos with models like DALL-E, Ideogram, Runway, and Kling. And if you're tired of robotic writing, their Humanize feature gives your content a natural tone that actually passes AI detectors. If you're into coding, check this out. Code LLM, a built-in VS Code editor, is included for free. And for advanced users, Deep Agent is like an AI sidekick that can create full websites, apps, reports, travel plans, literally anything. Plus, it's built for teams. You can easily invite collaborators, share chats, manage access, and even plug in tools like Slack, G Drive, or OneDrive to build smart chatbots. All of this, just $10 a month. Way cheaper than buying each tool separately. Head to chatllm.abacus.ai or hit the link in the description and get started. You'll be surprised how much this streamlines your workflow. And now, back to our topic.
The storm.
To understand everything that's going on, we have to go all the way back to 2017. At that time, their stock was flying on the stock market. In just 5 years, the share price of this company had practically multiplied by 4, and the expectations for the future were really positive. Boeing's new models kept on attracting orders from all over the planet, and even Donald Trump, already in the White House, was happily selling them as a way to reduce, that darned trade deficit. So naturally, their sales were flying. At that time, it was all good news. Orders were breaking all records, sales were soaring, and Boeing was completing an ambitious corporate trim-down plan. Because let's just say that for years, it was outsourcing a lot of activities to focus exclusively on the most lucrative areas of the business. We're talking about a process that was making the company much more efficient, much more agile, and obviously much more profitable. Just take a look at this graph. As you can see, not only was its revenue flying, but also its profit was soaring. In 2018, it was well over $10 billion, up 160% from 2007, its best year before the great financial crisis. And, as I said, its catalogue was also being updated at full speed with new and promising models. And to top it off, a large part of the investment costs had been passed on to its suppliers. The result? In hard cash. In 2018, Boeing led the field to pocket nearly $14 billion. And the question is, what did the company do with all this money? Well, it basically pushed through a huge share buyback program. In other words, everything was going smoothly and at full sail, or at least that's how it appeared. Visualeconomik community, in 2024, this same company recorded a loss of almost $12 billion. And if we look strictly at the cash flow, things were even worse. $14.3 billion were lost in a single year. And so the question is, what on earth has happened to a giant that has been in the red for 6 years now? Because the truth is that since 2018, Boeing's performance has been terrifying. It's been nothing but bad news. The price of its shares, for example, has at times plummeted more than 60% from its peak. And what's worse, between 1st of January 2019 and 31st of December 2024, in terms of cash, let me stress, hard cash, this titan of the skies recorded a negative free cash flow of $36 billion. This has led to a fourfold increase in its debt volume, from around $13 billion to more than $55 billion. That's brutal. And to top it all off, news like this now falls within the norm.
After LATAM incident, FAA orders overhauls on more than 900 Boeing 787s. Seoul orders inspection of its entire air operation and Boeing 737-800s after lethal crash. An American Airlines Boeing 737-800 catches fire after emergency landing in Denver.
But let me say it again. The question is, what on earth happened in 2018? Well, a tragedy that I'm sure you all remember.
Lion Air plane crash. A Boeing 737 plane crashes into the sea off the coast of Jakarta.
The MAX took off badly from the start. It was released too hastily. You see, Boeing's arch rival, Airbus, had launched a very fuel-efficient, narrow-bodied model that started selling like hotcakes. So what did Boeing do? Well, they took their 737 and modified it on the fly to be able to respond to Airbus as soon as possible. And it worked. The new version became no less than the best-selling aircraft in the history of this company. And there's even more. By using the design of an existing aircraft and not having to develop a new one, they saved a lot of money. At the same time, they also reduced training and preparation times for pilots, so commercial and financial success was on the cards. The result? Production had to be ramped up in a big way, and that's exactly what they did. They increased production so much that suppliers could not deliver fast enough. Boeing even had to use employee parking lots to park planes with parts pending. And not only that, the pace started to become dizzying. Overtime, weekends without a break, components placed at full speed. Soon the quality problems started to skyrocket. So what did Boeing management do? Demand that production ramp up even faster. They had to produce 52 MAX models per month, an unprecedented rate. Of course, that wasn't going to be the worst of it. You see, there was such a rush to get this plane off the ground that basically what Boeing did was to incorporate larger, more efficient engines than was structurally desirable. And, naturally, because the engines were larger than those of its predecessor, Boeing had to change their location, and with it, the aircraft's balance points. As a result, the nose of the aircraft sometimes dipped too much. The company knew this, and that is precisely why it tried to solve the problem through software. And if this in itself sounds strange, it was just the beginning of all the headaches. Because this software depended on a sensor that, let's just say, was not working very well. On top of that, it's suspected that this sensor could also end up causing quality problems in the electrical system. And to add insult to injury, the pilots were not trained in this new software, so they had no idea exactly how it worked. And so, in the end, disaster struck. On the 20th of October, 2018, at 6:20 AM, local time, Lion Air Flight 610 plunged into the sea. And then, just 5 months later, Ethiopian Airlines Flight 302 crashed shortly after takeoff. In total, 346 people lost their lives. It was a real tragedy. Of course, as you can imagine, the aviation authorities almost automatically suspended the operation operating license of these aircraft, which were grounded for about 20 months while they tried to fix all their problems. And let's see, as I said, it's considered that the fault was in the software and in the sensors that I mentioned before, but the truth is that during the investigation, it was discovered that the airplanes had many more problems. The House Transportation Committee's final report described serious problems with Boeing's production lines and quality and safety controls. And it's not just about this report. The truth is that these aircraft, despite being new, have experienced many problems and have required much more maintenance than expected. In the end, haste was the deciding factor. But that was not the only issue. A corporate strategy that went too far had a lot to do with the entire mess. We talked about the obsession to cut costs and, above all, the massive outsourcing process that led Boeing to practically only design and assemble airplanes, nothing else. The responsibility for everything else was passed on to a bunch of suppliers. It got to the point that even this 787 Dreamliner, one of the most important aircraft in Boeing's portfolio, was mostly designed by the suppliers themselves. Crazy. Not surprisingly, the problem is that this caused Boeing to lose control of the chain. And the question is, why were they so aggressive? Well, basically because outsourcing was so much cheaper. And not only was it cheaper, but it also reduced the capex needs. That is, the money, the investment that Boeing has to spend to set up the plants, buy equipment, machines, and R&D. With outsourcing, all this was the responsibility of the suppliers, which allowed them to free up billions of dollars. And what did they do with all that money? Well, as I told you before, they basically bought back shares and paid dividends. Specifically, during the last decade, this company spent $43 billion buying back shares and another $22 billion paying dividends. We're talking about a total of $65 billion, an average of $6.5 billion per year for a company that was going from bad to worse. Well, the fact is that the rushing, the quality problems, the loss of control, the fines, all this is what has made the last decade such a terrible one. Boeing has had to face a lot of cost overruns to make up for the mistakes and pay compensation. Its aircraft has spent a lot of time being grounded, deliveries have been delayed, and the company has lost a lot of market share. The result? Well, the losses of almost $40 billion that we saw earlier. In other words, a disaster. Of course, this has led to changes. Boeing needs to reduce debt, take back control of the production line, and restructure its business. And that is what they are doing.
Boeing to sell part of its navigation business in $10.55 billion deal. Boeing to lay off 17,000 workers amid financial difficulties. Boeing moves to raise $19 billion in capital.
Sales, capital increases, task reintegration, and dismissals. This is the new reality of the North American giant. But now that we know where we are and how they got there, the question is, what can we expect? Well, let's take a look.
Positives and negatives.
A year ago, in April 2024, a series of hearings were held in the US Senate to review safety issues surrounding Boeing. The conclusion was not particularly positive. 5 years after the first MAX accident, many of the problems related to corporate culture persisted.
There is a disconnect, for lack of a better word, between the words Boeing management is saying and what employees across the company are seeing and experiencing.
On top of that, the company is still in the red, from which it does not expect to escape until at least 2026. And that's only if the much talked about recession doesn't happen, because if the economy turns around, Boeing could be the most damaged manufacturer. Why? Well, because with everything that's going on, if orders have to be cancelled, they will be cancelled for the Americans before they're cancelled for the Europeans. There's no doubt about that. What's more, despite the stock market correction, the truth is that the company does not seem to be exactly cheap. Look, even if we look at the enterprise value sales ratio, we can see that it is still well above its historical average. And this is because there's now a huge debt that they have to deal with. This debt has led Fitch, for instance, to place them on the verge of a junk bond rating. But hold on a minute, because it's not all bad news. Aerospace has been one of the fastest growing industries in modern history, and nothing leads us to believe that this will change anytime soon. While relatively mature markets such as Europe and the United States continue to grow, Asian markets are now going wild with massive aircraft orders expected in the coming years and decades. At the end of the day, we're basically talking about a duopoly. So Boeing has a lot of business secured. In fact, during the first quarter of this year, the American company delivered 130 commercial aircraft, up from 83 in the first quarter of last year. So on this front, things seem to be looking up. Then another piece of good news that is eagerly awaited is that finally, after 1,001 delays, the 777X, the new wide-bodied star of this North American company, will start to be delivered in 2026. And if this ultimately happens, it would obviously be good news. Well, the result of all this is that estimates suggest that in 2027, Boeing could return to a free cash flow of $9 billion. This is not crazy for a company with an enterprise value of more than $150 billion, but if confirmed, it would be a return to a much more positive path. And recently, they have also had another piece of good news, nothing short of a rescue of sorts. I am talking precisely about this.
Boeing beats Lockheed Martin for Pentagon jet fighter contract.
The Pentagon has given Boeing the lead role in finalizing the development and preparation of the F-47, the aircraft the US government wants to replace the F-22. The F-47 will be a stealth aircraft with highly advanced stealth capabilities, long range, devilish speed without having to use an afterburner, and full integration with drone systems. It's a 6th generation fighter bomber designed to far exceed China's capabilities. Well, to give you an idea, each of these aircraft is expected to cost around $300 million, so it could be a great long-term deal for Boeing. The contract it has been given for now is valued at more than $20 billion. And of course, if this company does its homework well, this positions it as the great favorite for becoming the manufacturer of the future, which would be a very significant business. And take note, because the first aircraft are expected to leave the factory in 2030, so it won't be long before we see whether or not Boeing takes advantage of this opportunity. It could certainly be of great help. But of course, let's not be too hasty in letting off fireworks either. Boeing's problems are still there. They don't have it easy. The red figures have fueled a huge debt. They have not yet proven they are able to control costs while improving their quality levels, and competition may grow in the coming years. Of course, their problems also indicate something else, that Airbus is doing a formidable business. But we'll talk about that another day. The question now is, do you think Boeing will weather the storm and get back on the runway to profitability? Do you think this company could be a good investment? Let us know what you think down in the comments. And now, if you found this video interesting, don't forget to give it a like and subscribe to the channel if you haven't already done so. All the best, see you soon.